Okay, in this video, we will look at how the doji after a tall white candle becomes a very strong resistance. Now, in this chart, you will learn how a sophisticated reading of Japanese candlesticks can help you a lot in your trading. Now, I see a lot of patterns here, okay, and check if you can find those patterns yourself as well. Okay, I will discuss each and every pattern that I have noticed here. See if you know those patterns. So this is the doji after a tall white candle. This is a daily time frame chart of Mastercard. So let's try to understand what's going on here. So the first pattern that I see here is this doji candle. Doji itself is a pattern. It's a reversal pattern. It has the same open and the close. So that's the first pattern. The second pattern that I see here is these two candles, the tall green candle and the doji candle. That becomes a bear harami pattern. It comes after a uptrend. If the first candle completely engulfs the second candle, the color of the second candle does not really matter. The second candle should have a body which is as small as possible. The third pattern that I see here is that those same two candles, it is also called as a bear harami cross. Okay, so first one is doji, second one is bear harami, and the third one is bear harami cross, and the fourth one is doji after a tall white candle. Again, these two candles, doji after a tall white candle itself is a pattern, because we know as professional candlesticks trader that when a doji appears after a tall green candle, then the the doji after the tall green candle becomes resistance. Okay, so when I say white, I am referring to green. So you have black, white, red, green, whatever color you want to use. The reason why I use white is because generally a white or a hollow candle is used to represent a bullish candle, and a dark or a black candle is used to represent a bearish candle. In this case, the red candle is bearish, green candle is bullish. So again, let me repeat. The first pattern is the doji, the second is the bear harami, the third is the bear harami cross, and the fourth is the doji after a tall green candle. Number 5, if you look at these two patterns, okay, that's a bearish engulfing pattern, right? It's a very strong bearish reversal pattern. Okay, so those are 5 patterns which we just discussed, and as you can see, I have drawn the resistance line here because we know that the doji after the tall green candle becomes resistance. So as you can see, look at the precision of Japanese candlesticks. None of these candles have been able to close above that blue line. Okay, let's come to this part of the chart. What are the patterns that you see here? Well, if you see, look at these two candles, that's your number 6. That again is a bear harami. Okay, as I discussed earlier, it comes after a uptrend. The first candle completely engulfs the second candle. The second candle can be any color, and generally for a bear harami, the height of the real body of the second candle should be 20% or less, or of the height of the prior long green candle. Okay, that's the criteria. So again, a bear harami. And if you look at this single candle, that's called as a hanging man. Okay, it's just a reverse of the hammer. The only difference between the hanging man and the hammer is that the hanging man appears after a uptrend. So that's number 7. Number 8, this candle, this is called as a high wave candle. It generally has a small real body, and it has long upper shadow and the lower shadow. Again, all of these patterns are reversal patterns. Reversal doesn't mean that the market will come down. Reversal means from here the market can either come down or go flat. So these are all bearish reversal patterns. So that's number 8, the high wave candle. Number 9, if you look at these two candles, a hanging man requires a confirmation on the next candle. So if the next candle closes below the close of the hanging man, that itself is a confirmation of the hanging man. So that is point number 9. Okay. Again, that's a bearish sign. This candle confirms the bearish implication of the hanging man. Number 10, you have this candle, which is obviously a shooting star. So that's number 10. Number 11, if you look at these two candles, what is that? That's a bearish engulfing pattern. So that's number 11. So this is called as a sophisticated reading of Japanese candlesticks. Okay. I have hardly used any Western indicator here. Okay. So if you want to read candlesticks the way I am reading candlesticks here, go to this link. Look at the Japanese candlesticks trading mastery program that I have created. This has more than 1000 chart examples just like this. It has students from more than 170 countries. As of now, the total number of students is 32,000 and it is rising. So each and every pattern I have discussed in detail in this candlesticks trading mastery program. It's my flagship program that I offer. It has multiple levels. As of now, there is level 15. I have reached till level 15. In this month, I will be launching level 16 as well. And each of these candle patterns that I have discussed, you will find hundreds of examples of each of these candle patterns. Okay, so that you can master that pattern. By the way, this is 11. If you look at this, that's the rising window. That's number 12. Okay. So coming back to the chart. So this is how the scenario is unfolding on this chart. So there is a case to go short here because clearly you have so many pointers here indicating that the market is most likely to go down. So if this rising window are not there, so rising window becomes support, right? So if this rising window was not there, let's say the shadow was like this, then you have a potential to go short here. That's your entry. You take the high here, that's your stop loss, and you take this support level, that's your target. So that's your reward, that's your risk. This is your risk, this is your reward. Reward to risk ratio, I think 3 is to 1 or 4 is to 1. So since this is a reversal trade, right, the reward to risk ratio is very high. The risk is also high, but the fact that we are getting so many bearish implications or so many bearish signs makes a case for taking the trade. And if you want to use Western indicators, what you could do is you could look at the RSI on this candle and the RSI on this candle. So if this is a rise in price between these 2 points, if the RSI is declining, that is called as a negative divergence. So if you do want to use Western indicators, you must know which tool to use. So RSI is a tool which can be used here. Even stochastics or MACD can be used to see what is the strength of the momentum here. You are most likely to get a negative divergence there. So that adds to the probability that the trade will work out. So in this chart, what we have done is we have looked at 4 things. Number 1, a mastery of reading candles. Okay, that is the first thing. Second is combining candles with Western indicators like RSI, stochastics, MACD, just to see whether there is divergence here. Okay. If you do not understand divergence, that's okay. It's a Western technical analysis tool where you see the price going up here, but actually the indicator falls, which indicates that it's a false rise in price. The momentum is weakening. Number 3, then we looked at risk management. Okay, these 3 concepts allow us to enter a trade. Now, once you enter a trade, you have to manage the trade, right? So, the fourth aspect, most important aspect, is trade management. And all of this should be considered from the point of view of psychology, trading psychology. Don't expect that you take a trade and the trade will always go in your favor. The trade might reverse and go in this direction as well. So that's where your mental toughness, psychology comes into play. As long as you get these four aspects right, you are doing well. Okay. So these are the four aspects that you need to learn. Candles itself will take you 1 or 2 years to master. Then you add another 6 months to master Western indicators. Risk management, trade management is not very difficult. Risk management is very easy. Okay. It's just mathematical calculation. Trade management can be tricky. You can spend a lifetime learning how to manage a trade, but at least master these two. It will take you at least 2 to 3 years to master these things. And that's why I have created the Japanese candlesticks trading mastery program. Go to that link and check out my training program and look what happens here. Is it a surprise that the market has gone down? By the way, you look at these two candles, this is giving a confirmation for the shooting star. That's called as a price confirmation. That's another signal that you get. So you could have gone short on this candle as well. So we went short at the shooting star, and look, within 3 candles the target was achieved. Like if you are getting 4 is to 1 or 3 is to 1 reward to risk in just 3 candles, that's an awesome trade. Okay, look, 1 2 3, that's it, target achieved. You don't even have to wait for all of this, but this is provided there is no window here. Okay, I'm assuming that in such scenarios there is no obstacle in between. When there is no obstacle, you can confidently take the trade. So remember, the doji after a tall white candle becomes resistance, and that resistance, that bearish implication of that resistance, is continuously getting confirmed here.